Thank you very much, Maggie. That was great, and Jamie, thanks for that advertisement for Sadali. That was very informative, but a great way to kick off today. So, before we kick off, my name is Jimmy Rich. I'm a partner at Greenstone Partners, as Maggie just alluded to. I think, firstly, I'd just like to say thank you to everyone for coming back in from lunch. I know the alternative to this is a chocolate brownie and another flat white out in the foyer, so thank you very much for coming in. But I do hope that this session is going to be one that is going to be very interesting. As Maggie alluded to, we have seen a really big rise both in the occurrence of shareholder activism in the Australian market, and we've also seen it becoming more and more public. And with that, we've obviously seen all the tactics evolving that go with it. We are blessed today to have a really experienced panel, and I'd say both experienced in terms of long-term time in the saddle, but also really active recently in some of the most recent and public activities and shareholder campaigns that I'm sure the team will be happy to talk to over the course of the day today. So without any further ado, I might hand over. Jamie, if you want to kick us off, introduce yourself quickly, and then we'll get into the questions.
Yep, thanks Jimmy. So I'm Jamie Cameron from Sadali. I do kind of wish we had an Australian voiceover for that video, but as you might have picked up from that, we are involved in stakeholder engagement, stakeholder management. So there's a strategic communications part of the business, there's a sustainability consulting part of the business, and there's the one that I'm a managing director in, which is shareholder advisory, so working on campaigns for, as Jimmy was talking about with shareholder activism campaigns, but also just sort of M&A and BAU situations for our clients.
Jessica Curtis. I specialise in public market M&A at UBS, and so far as the panel today is concerned, I advise our corporate clients in relation to activist situations.
I'm Gabriel Radzminski from Sandon Capital. We're an investor, and we're a value investor, and we use activist techniques to try and maximise the value of our investments.
Gary Weiss. I've been involved in active value investment for probably more years than I care to reflect on, and taught Jamie everything that he now knows, and still pretty active in terms of markets and with activist campaigns.
Perfect. Well, as you can see, the battle lines are formally drawn across the stage as we start off today. So maybe we use that as the opening line. Gary, I actually had in here that you've been doing this for more years than you care to remember, so I clearly was listening on our preparatory call. Maybe we could use that as the kick-off. You've been doing this, I think I saw, for nearly 5 decades. What have you seen in terms of the evolution of activist investing in Australia?
Probably distilling it down into a couple of broad categories might be helpful. So what we've seen is certainly in more recent times a breakdown in terms of activism between what I'll call value-based activism and values-based activism. I think Gabriel will touch on the latter, but essentially that covers campaigns run by people with causes and seeking board change, etc. I'm more familiar with the value-based approach, and even then you can often distill, and again we're talking in broad categories here, the type of value-based activism into 2 broad categories. Short-term activism, what I call the sugar hit activists, those who are looking for short-term gains, short-term advantages, often involving fairly obvious strategies. Take a lowly geared company, tell the board gear it up, hand us a big dividend and we'll be off, as opposed to longer term activism, which is the field that I've tended to focus on, where one seeks genuine board involvement to shape the future of a company.
Okay, thanks, Gary. I think it's really helpful to sort of frame what we talk about within shareholder activism. Gabriel, you started Sandon Capital back in 2008, and at the time that was because you wanted to have a more strategic approach to investing. It was a hole that you'd identified in the market. Over those 17 odd years, how have you seen the market evolve, and bearing in mind some of Gary's comments as well?
Well, I think I think I'd subscribe to what Gary described in terms of his segmentation. Because of the discussion, I think I've got to touch on that values-based activism, and that's not what we do. We are very much in Gary's camp about focusing on value, shareholder value. But what's happened in recent times has been a real emergence of values-based activism, particularly along ESG lines, and I'm again reluctant to overuse that term, because I think governance and good governance ultimately determines everything else. But that's been driving a lot of activity and a lot of publicity around what's called activism, but we really focus on activism can and should be about shareholder value.
That's helpful. And then, so we've got this emerging trend, Jessica. We're seeing more, Gary, Gabriel, the breed is breeding. There's more and more of them coming to the Australian shores. How are you sort of seeing the reaction then from boards? How are they preparing for those approaches? And then once they have an approach, how are they responding to those approaches?
Sure, thanks for the question. Look, I think it's important to look at the market dynamics and what's really shifting in the ASX listed market, which is where we're seeing the prominence and the rise of activist shareholders. And really the trend towards passive money away from active money means that the relative amount of investment that is taken by active managers is less. And if you're an active manager who didn't allocate to CBA, life's pretty hard in order for you to be able to deliver alpha. And so increasingly we're seeing this breed of shareholders who are needing to find ways to justify their management fees and are kind of putting on an activist hat. And I think with that dynamic, you see a really broad spectrum of parties that potentially fall under the banner of activism, activist shareholders. From just shareholders who are becoming more active or more willing to speak publicly around their views, all the way through to funds that promote themselves as pure activists. And that spectrum's quite wide. So as a corporate advisor, we spend a lot of time now with boards where they're looking at what they need to do in terms of getting prepared for activism, and also in terms of how they make sure that they're communicating appropriately when an activist does arise. I think the focus there is in terms of looking at value, looking at the strategy of the company, and then in particular looking at the communications. So in terms of value, really an activist is going to arise where there's a disconnect between the fundamental value of the company as the way that the board sees it based on management's plans, and the market value. And understandably, shareholders are not happy where there's a disconnect there and are looking to try and agitate for change. Investors are structurally long, and so the activists are structurally long. They're looking to improve returns, and so essentially the objectives are aligned and should be aligned, which is doing what's in the best interest of shareholders. So then we spend time looking with the strategy. What is the board doing? What is their near-term strategy? What is the long-term strategy? And importantly, how is that being communicated to the market? So that's really where we're spending time with boards preparing. I'll speak in terms of some of the strategies, because I think, again, with the spectrum of different types of investors that you're seeing, there's a lot actually that's happening behind closed doors. There are campaigns that happen to play out in the public, and I'm sure we'll get to what motivates that kind of engagement from being behind closed doors to being public. But most of the work that we're doing is really, it's an active dialogue that the shareholders are having with the board. And for the most part, boards really encourage that dialogue. So long as it's kept constructive, so long as it's an intellectual and honest debate, it's absolutely welcomed by boards, and that's the general disposition that we see, that they're welcoming that discussion so long as it's constructive. I think the final point around when these campaigns become public and are somewhat, they can be a little bit more aggressive, or the tactics can become a bit more combative or a bit more negative. I think where we're advising boards in those situations is don't see it as, the board versus the activist. It's not really a two-sided debate. It's really about winning the hearts and minds of your broader shareholder base, because as I've said previously, the objective should really be about driving shareholder value and doing what's in the best interests of shareholders.
Gabriel, you're nodding, you're jumping, you go.
All right.
What would you say to that?
I think just a couple of observations on Jessica's comments. This idea that a lot of activism takes place behind closed doors, to me, is a little bit of a furphy put out by managers who want to be seen to be active. To me, what happens behind closed doors is advocacy. I think active managers in Australia are very good at pushing their points of view, debating them and arguing them with management teams and with boards, and that necessarily happens behind closed doors. Activism is what happens when advocacy doesn't work. So it's the extension of advocacy is where you end up having to be activists, and that for us in our operation, how we work is things escalate because they're not being changed. The advocacy doesn't work, therefore you move to the next phase. So I just, bit of a nuance, but make that distinction. I think the other point to make is that fundamentally, most of the issues that we identify simply come down to agency conflicts. Conflicts between ambitions of management teams, sometimes boards, versus what shareholders want to do. And I think Jessica's point of ultimately it's a contest of ideas that takes place among the shareholders, and boards will bend to the will of a majority of shareholders in the end.
Excellent.
Right of reply?
Yeah, absolutely.
I don't think we need to turn
go
this
forward,
into
go forward.
but it's worth. I completely acknowledge the points that have been made in terms of when I say that we're working behind closed doors. I mean, the reality is, there are a number of transactions and strategies that are coming out of boards which have, to a lesser or greater extent, emanated from discussions that shareholders have had with the board, but haven't necessarily then come out to claim ownership or responsibility for guiding that discussion.
What I'm saying is that that's advocacy, and I think that's what all good active managers should be doing, is engaging with their boards, because the system works best where there is that healthy tension between boards, management and shareholders.
So Gabriel, we're seeing more and more of what you call genuine activism emerging. Do you think that's a result of more shareholder activists, people prepared to push that boat out a little bit further? Are activists taking a different approach? Are they more happy to go public, prefer to go public? Or do you think it's a case of is it a sign of the times, what we're seeing, a board's reluctance to engage? What do you put down the increase in what you call activism into the market?
Look, I think it's a function of the amount of capital that is allocated to that supposed strategy. I think also it's a reflection of corporate performance generally. When things are going well, there's very few things that Gary or I might necessarily do if everyone's happy. The opportunity arises when something's going wrong, where there is a disconnect between genuine value, intrinsic value of a company, and the market price. So I think it's more a function of the circumstances than necessarily how many people are doing it. I think it's also a case that when markets are rising, people tend to be a bit more forgiving.
Okay.
I think if I could add too that I endorse what Gabriel has to say about the advocacy point. Matters only spill over into the public arena when boards fail to constructively engage. The other thing though, which is again I think a very large philosophical element in all of this, these often boil down to a contest of those that have substantial skin in the game against those who don't. And I've been a strong advocate for many years of appropriate proprietorial representation. I firmly believe that companies which are owned by shareholders, where you have a significant shareholder with substantial investment in the company, has, I won't say the right, but prima facie, a board should seriously consider, where a request is received, for proportional representation relative to the size of the investment, that be favourably received. After all, why would you wish to exclude people who've got very significant investment in the company from having a role in the oversight of capital allocation and so on, unless there are extenuating circumstances, so you wouldn't readily admit a representative of a competitor company or whatever. And often these contests do distill down to a battle between those who have skin in the game and those who don't.
Okay. All right, we might just pause the backwards and forwards there. Jamie, your American friend told us before you're a market leader in this space. What are you seeing in terms of the prevalence of activist shareholder campaigns over recent times?
Look, shareholder activism campaigns are such specific situations, so they're not really something that you would count, because you could have one situation which is enormous, and the two gentlemen to my left here, they're involved in current things at the moment as well. So rather than looking at activist campaigns and the number that might be occurring, because the truth is a lot of it happens at the lower end of the ASX, a lot of those resources companies, sub 50 million market cap. But something which you can track, which does sort of demonstrate what's going on in terms of active investors and them being a bit unhappy with their investments, remuneration strikes. The year before last, there were 41 strikes in the ASX 300, so 1 in 7 or 8 companies received a strike, which was a record well above the previous record. So we had that spike in the graph, and then we thought, okay, will this settle? Where's this going to settle back down to? So then last year there were 40. So that elevated level of scrutiny and investors voting accordingly if they have an issue that they hold dear, that's something that is now sticking around, it seems. And then in terms of what's happening this year, we had those with the 31 December year end, they had their AGMs in sort of April, May. There were 5 strikes out of about 50 companies. There were 8 last year, so we're kind of around the same area. And at the moment, given it is sort of AGM season, we're deep in the trenches with clients, and just keep your eye out. There's plenty of strikes to come.
Okay, so it's not going away. Shareholder activism is here to stay. So then, Jessica, you've worked overseas. You've worked in the US. You've worked in New York. You've worked on a number of these campaigns. You've seen this over an extended period of time. Given that we do in Australia follow a number of sort of global trends, how do you see this playing out over the next 12 months? Where are we going to go from here?
So when you look globally, obviously you've got a deeper pool of capital, bigger markets, and it's easier to identify sectors and trends where you're seeing more activity. So if we take a brush and start there, in the US, tech and industrials and healthcare have been the primary sectors which have been recently in the headlines around activism. Now, I would note that the US activist market is in line with what Gabrielle said. It's a very public activist market, and most campaigns do play out publicly, so it's easier to, again, track those statistics. In terms of Europe, similar trends in industrials and healthcare, but a little bit more in consumer and energy. But a trend that we've seen shift quite dramatically in Europe is previously there was a lot of ESG-based activism, and we could call it ESG-based advocacy, because to the point around driving shareholder value, that's really unwinding a little bit now, and you're not seeing very many campaigns that are being led with an ESG headline. It's really that might be one element of the campaign. But in terms of Australia, we don't really have a deep enough market that you can pinpoint 1 or 2 sectors that are likely to be particularly vulnerable to activism. And so what the way I'd answer your question is look at kind of the trend in activity and what's being targeted. So, historically, M&A was a key target of activist investors, particularly looking to separate assets, unlock value, sell assets, divest, etc. The trend then moved a little bit away from that and more towards capital allocation, efficient balance sheets, distributing returns back to shareholders, and then it's kind of migrated a little bit more now to points around board representation, and there's also an associated element of operational performance and trying to improve the operational performance. So I'd say that that will continue to be the case. Those will be the trends. Point that I'll tread lightly here, but I think that we will continue to see campaigns where shareholders are looking to block or renegotiate publicly announced transactions. And I also think that rather than being a tool to use in a campaign, being that M&A should be considered by the board, I think that there might be examples where some of these well-funded investors are looking to become the M&A acquirer themselves.
Okay. And presumably, Gabriel, a situation
I have no interest in bidding for Southern Cross.
Gabriel, presumably a desire here to be involved in how the decision is made.
Everyone's looking at you.
On what?
I take you.
All right, I'm going to move this one on. All right, the role of shareholder engagement advisors. Jamie, clearly one right up your alley. How do you see the role as a shareholder engagement advisor for both the target and an activist investor, and how do you think this is likely to evolve?
Look, it's evolved so much already. At the beginning of my career, you'd sort of just get a register, you'd send a letter out there, and then you just call them and see what votes you get from that. But the game has changed so much because there are just different types of stakeholders that you now have to try and pinpoint and target. So that's what we're helping clients with, whether it is on a defence, in a defence capacity, which is most of our mandates, but we do sometimes work with activists. You need to look at. You need to know who the instos are now. You need to know who the underlying asset owners are now because they might retain their voting rights. You need to know about retail brokers. You need to know about proxy advisors. You need to know about all these sorts of things. So shareholder engagement, I guess that's why we're now calling it stakeholder engagement or stakeholder capital, as my American friend told us up there. So it has changed so much in that way just to get to this point, and then now what's happening is getting through to shareholders is changing. It's sort of like a political party wanting to target younger voters. Like, you need to go where they live, so you need to figure out who they are, where they are, and then go and engage with them in that manner. So there's a lot of work that we're doing far beyond just now picking up the phone. There's online. There's you can reach people through direct mail outs. There's podcasts nowadays. There's all sorts of things. So having to cover off all those different stakeholders, it's so important now for companies to be on top of it. There's a fascinating case study unfolding at the moment involving Warradar Resources. They're being acquired by Capricorn Metals, or proposed to be. Before the scheme booklet came out, before the independent experts report came out, there were voting intention statements signed by shareholders claiming to hold 16% of issued capital, sent that to the company. They had to then put the list of potential dissenting shareholders in the scheme booklet. And then just 2 days ago, I think it was, there was a bump to the merger ratio. So who would have thought that you now have to sort of police what's going on on hot copper because of how sophisticated people are getting with just their engagement. Before, if you wanted to find out if somebody was a shareholder, you'd have to go and inspect the register and look at all the names and write them all down and then go and look them up in the phone book. But now there are forums where people are getting together and they're sort of, wouldn't say acting in concert because then that has, sort of other ramifications for them. But they're so coordinated. So now you just need to be on top of every single different constituency and different stakeholder to ensure that your deal gets across the line without having to increase the offer or whatever it might be. So that's how our business has changed so much, having to sort of keep up with changes in the way that people consume their media, the way that they engage with each other. In terms of working for activists or working for companies, we offer all the services to this to either side because we're fortunate enough here in Australia to be a full disclosure market. So an activist can see the whole register; they can see whatever the company can see. So it does make for very interesting work. If you guys want to have more public fights, then please go ahead.
I think just one observation, taking on what both you've said, Jamie and Jessica, and presuming that the audience here are largely advising companies. I'm probably shooting myself in the foot. The defence against people like us is to be constantly prepared. Because, for example, we begin our campaign, we invest in our companies without even first visiting them. We take the view that everything we need to know is in the public domain, and we do our research before we invest. We will then at some point make a decision that, for example, we need the help of Sodali, and we will do that weeks, if not months, before anything comes to the eyes of the company, and then they're always going to be on the back foot. And so, for an audience like this, or for Jessica, it's that constant engagement with the companies to always be prepared, lest someone else is preparing something else in the background.
Yeah, no, I agree. I think that was the change that I was going to note. I mean, historically, when we've worked with the advisor firms who've been able to do the register analysis, it's more been one-off. Heading into an AGM, you think there might be a strike. It's about running an analysis and understanding where those votes are going to land. I'd say increasingly now it's a constant engagement. It's not kind of going into fight a fire, but it's actually, we're not waiting until a couple of months before an AGM in order to review the register. It's a constant dialogue. It's the stakeholder engagement. It's mapping out all of the parties that you need to be communicating to. It's a consistent message. It's consistent disclosure, but it's also making sure that you are targeting it appropriately to what resonates and what's important.
Yeah, the last thing a company wants to do is, be engaging with an investor for the first time at the 11th hour looking for support. You'd want to have established communication with them, and you're talking to them all the time and providing them with updates. So that's certainly something that we're telling our clients in terms of activism preparedness. Know who's on your register, know who they are, and actually speak to them regularly, and then have your house in order in terms of your public disclosures as well.
And to be perfectly blunt, when we assess our opportunities, we're looking for two things. We're looking for the value opportunity, the mispricing, the discrepancy of price to intrinsic value. We're also looking for what we could reasonably conclude as soft targets, i.e. which are the companies that are underpriced and not prepared. I'm not going to go up against someone who has everything ready. Why take a difficult fight when there are plenty of other easier ones?
The difficult ones are the most enjoyable, Gabriel. I mean, look, at the end of the day, the incumbents have a significant advantage. And that arises for a number of reasons. If you take the retail shareholder base, almost invariably, unless you've got a company that's supervising a disaster, retail shareholders, to the extent they vote, will generally vote with the board. Then you've got the institutions. Increasingly, a number of them are themselves actually making the decision about voting. But for a long period of time, many, if not most of them, were reliant on proxy advisor recommendations, and it needed so if a proxy advisor recommendation was to vote against the activist proposal, any particular fund manager who wanted to vote contrary to the recommendation would need to prepare a paper and try and get approval to vote as they thought appropriate. Now that is changing to some extent, but certainly with institutions, proxy advisor recommendations are important. They don't always prevail. And then you've got, frankly, I think the inertia. People generally are, again, unless there's a real disaster in front of one, generally nervous about change. And so better to go with the failed jockeys on the horse than try a new jockey.
Absolutely. I mean, we encounter that where people would rather, they know that the ship is heading into the iceberg, and they would rather continue on the course they're on than take the risk and ultimately be responsible for changing course, even if it might save them. It's that inertia that's the enemy of what we do.
Okay. It does sound like people are listening. We've got an entire industry clearly evolving of preparing people for these shareholder approaches, being ready, which is presumably going to reduce your pool of approaches over time. But I'm sure you'll be able to find plenty to keep going on, or maybe Gary will find more in the difficult category. Conscious of time, some war stories. What have you learned? Gary, I'm going straight to you with this one, with that grin on your face. What have you learned from recent campaigns? Both success and failures. What have been some of your key learnings over time?
Well, firstly, you need persistence. That's probably a statement of the obvious, but you need to, I think, be able to advocate your position clearly, constructively, and with logic. Now, they don't always go hand in hand, but my latest campaigns have really been around the fundamental issue I addressed earlier of proprietorial representation. I struggle with the concept that a board, reiterating my earlier comments, with little skin in the game, feels that to reject having substantial shareholders alongside in the boardroom is something that they should embrace. And often the companies that we target have issues. I mean, if they were pristine performers, I doubt either Gabriel or I would be particularly interested in running an activist campaign. What would you be campaigning for? So these companies that are often replete with issues, to be blunt, the last thing they need in their life is a contested proxy campaign. It is highly disruptive to the company, it's highly disruptive to management, and I can tell you it's highly disruptive to the morale of the people employed by the company concerned. And when I've ultimately succeeded in inviting myself onto boards, the number of people within organisations who come to me and say, thank goodness this is over. We're trying to run our business. We've got stakeholders. They ring us every day that the company's in the Financial Review and the Australian. We've become a punching bag for public and shareholder opinion. And thank goodness, this clown show is now over.
Okay, Gabriel, same question to you. What have you learnt? Recent campaigns, previous campaigns?
Look, I'd reiterate Gary's comment about persistence. We are incredibly persistent and tenacious where we see value, and just because there's a setback or just because it's difficult doesn't mean we'll give up. We are genuinely long-term in our investment horizons. Our fund has been, our flagship fund's been going for, it's now in its 17th year. We've got still some investments in the portfolio that are 15 years old. And that's because things have improved, but we still see opportunity. And so we will stick it out. Our investment horizon is typically far beyond what most management teams, boards, and other shareholders are prepared to withstand. And as long as we see things moving in the right direction once change begins, we'll stick through it. And to Gary's point about being disruptive, I had a conversation with the chair of a company not 3 weeks ago, asking whether we would consider, moving on or withdrawing certain things that we were doing that were causing angst to that company, its customers and its staff. And my response was no. Simply because to us they're short-term issues that if change occurs can be resolved. I think it's also worth pointing, and we've had similar feedback with that Gary was talking about, particularly with what I'd call the people who actually do the work in a company, not the C-suite people, but instances where we've fostered change at companies and suddenly you get a new board, a new chair, sometimes a new CEO, and then you hear messages from people who work in the business saying, thank goodness someone made a change because it was untenable. We're typically not coming up with anything that is necessarily unique. What we're doing is we're trying to change the priorities of the board in terms of what the agenda items are that they will act upon. So, you know, for us, we always distinguish. We're not necessarily trying to convince the board of something because we view the board as having made its decision. We're trying to convince shareholders that there is a different way of doing things, and ultimately boards will, you know, bend to the will of shareholders, as I mentioned previously. You know, rare is it that we encounter boards and management teams who are wantonly doing things badly. I do accept that most of them are well-intentioned, if not misguided, but there is genuine intention, and that's why it's actually so hard to change their views, because they think they're doing the right thing. But we take a step back from a shareholder perspective and say, well, actually, we don't think it is.
Okay, that's helpful. Again, conscious of time, Jess, maybe I'll move to you, the tactics. I suspect you don't weigh all the tools in your kit bag, but what tactics are you seeing being employed in the current uncertain times, and how do you sort of see that playing out over the next 12 to 24 months?
Look, I think we've actually touched on a lot of the ways that, you know, this is playing out. I mean, we have a very efficient regulatory system which enables shareholders to be able to have an active dialogue. It's a relatively small threshold to be able to requisition AGMs. We have reporting every 6 months. There's the AGMs. So it's an environment that is really conducive to this dialogue. And I think that, you know, point I made at the start is boards welcome the engagement with shareholders and hearing from them. So in terms of the tactics, you know, I don't love that word because it almost sounds combative, but the reality is it's looking at the registers, it's understanding who are your shareholders, what's important to them, what motivates their investment decision, and unpicking that sometimes from what motivates their voting decision, because I think that, you know, we mentioned the increasing pacification of the market, but you actually see that sometimes that's really, you know, there are funds that don't have a choice but to hold certain companies because they sit within, you know, as an index fund, and really the shareholder vote is the opportunity that they have to express frustration. So you see that's why, you know, strikes do play out, and I think that that's a really healthy part of our market. So, you know, the strategies that we use are just making sure that, you know, to the extent that there is a view within the boardroom, within management, that this is the strategy of the company and it is in the long-term best interests, you know, having that dialogue with shareholders, getting their feedback, and, you know, making sure that it's you know, done in a constructive manner.
Okay. Well, thank you all for your for some of those comments. I suspect, given the panel here today, there may be some questions from the floor. Does anyone have any questions they'd like to ask?
Thanks. I have a question about the role of the ASX and maybe some other regulators in this market. How do you see the role of ASX in either facilitating or maybe hindering shareholder activism in this market?
Gabriel, do you want this one?
Look, we're dealing with that right now in the Seven West Media Southern Cross scheme of arrangement, where there is, in our opinion, a glaring loophole in the ASX listing rules, where the ASX on the one hand acknowledges that shareholders should be given the right to vote on the placement of shares in excess of 15% of the issued capital of a company, placement of shares for cash. More than 50% share issuance is a reverse takeover, change of undertaking, requires a shareholder approval. In between the two, boards have clear slather to go and issue shares as much as they like. It's worth noting from the ASX perspective, and this draws up the, you know, some of the conflicts of interest that they need to manage. In FY25, there was roughly $90 billion of new capital, secondary capital listed on the ASX. And they disclosed that 41 billion, 45% of that was from what they describe as other secondary, including script for script transactions. So you can see that from an ASX perspective, it's there's a decision to be made of whether you should restrict, because as a shareholder, I'd like to be able to vote on everything above a certain amount. We've put forward resolutions that mirror the resolutions that Aurora are putting forward at the behest, we understand, of Alan Gray, that will require, if passed, shareholder approval to issue more than 25%. Again, we're not trying to be churlish and say, we don't want you to issue any shares. We understand boards need to have some latitude, but there's got to be some limits to that. And at the moment, we think that ASX are not responding promptly enough, quickly enough to the review, and you're seeing a flurry of transactions going through. I mean, you need to look back at Perpetual Pendle, an absolute disaster for Perpetual, James Hardie ASEC. Now we're looking at the case of Southern Cross and Seven West Media. There's a few little mining companies. You throw into that the advent of the new ACCC guidelines coming 1st of January, where it seems as though there might be a flurry of activity to get ahead of those. The regulatory framework affects us all, and I think it would be a shame to see changes to the regulatory framework that ultimately disenfranchise shareholders.
Richard from the ANZ here. Jamie, you said earlier that there were 40 to 50 remuneration strikes, kind of repeating year after year now. What's the main reasons for those remuneration strikes? And feel free to use any example, but ANZ, obviously, I know the answer there, so.
Yeah, look, every company is unique, every situation is unique, every register is unique as well. You know, there could be some situations where there are a whole bunch of KMP that hold stock and they can't vote on that resolution, so sometimes it's quite easy to get a strike in those instances. But just generally, you know, a lot of it is, of course, tied to remuneration. That's what the vote is about. So there's been a disconnect between pay and performance. There's been a misalignment, I suppose, between what the executives are receiving and the shareholder experience. But it is also used by investors just to express dissatisfaction with a company. If you have the patience for it, you can also try to hit them with 2 strikes and get into a spill meeting. So there are a lot of different factors, but it is perhaps showing that you know, the active investors aren't sort of just happy to cop bad outcomes anymore, or they're seeing that some boards aren't being tough enough on remuneration outcomes for when a company does there could be an investigation by ASIC, or there could be something, anything. So, yeah, look, a variety of factors, and it's usually that disconnect between the shareholder experience and people getting bonuses.
Maybe one final question. There we go.
My question is for Gary. I was wondering about your lessons from your dealings with Webjet lately, and what would you do differently next time?
Sorry, can you just repeat that? Sorry.
Your lessons from Webjet?
Well, it's obviously a matter that's very live. It'd be fair to say that probably a statement of the obvious. I mean, Webjet's had a fairly inauspicious start to its public life, having been spun out of the parent entity. We think the company fundamentally is an excellent company. It's got a very good franchise, but in the world that we're coming into with AI, etc., competition is clearly going to ramp up. We see ourselves as wanting to help, not to hinder. And we've tried to engage with the board. We've clearly made the point that together with our partners in our consortium, we hold 17.1% of the company. The partners in the consortium have considerable experience in the sector, looking to assist. We have issues about capital allocation and all sorts of other things where we think everyone would benefit from having a large committed shareholder around the board table. But our attempts to get representation so far have been unsuccessful, and as was noted in the article in the Financial Review, again comes back to a very fundamental point which underlines a lot of our activity. Our group holds an investment which is 65 times larger than the investment of the entire board in the company. And again, I come back to a very fundamental point that I made earlier. Webjet, as good as a business that it is, has its challenges. The last thing that management and its team needs is a disruptive general meeting and all the publicity that goes alongside that of a company which becomes a public punching bag.
Thank you.
I think we can call it there. That is time for today. So guys, thank you very much for your time. Thank you very much everyone out there in the audience. Maybe a quick round of applause for the panel.